Sweeping policy support measures to boost the world's second-largest economy. On May the 7th, China unveiled a 10-point policy package aimed at enhancing market confidence, boosting long-term liquidity and supporting innovation-driven growth. The People's Bank of China, which is China's central bank, cut its policy rate and reduced its reserve requirement ratio. Additional measures were also announced to shore up technological innovation, consumer service and businesses impacted by U.S. tariffs. Now, China's economy grew by 5.4% during the first quarter of this year, and value-added industrial output also expanded by 6.5% year-on-year. Retail sales grew by 4.6% in the first quarter. Pretty good results for that period of time. Against the better-than-expected quarterly figures, why is China rolling out these measures? How will they affect the economy in the short to mid-term, and how have markets reacted so far? Welcome to a special edition of The Point with me, Liu Xin, coming to you from Beijing to help us understand these points. Joining me from Shanghai, Edward Tse, founder and CEO of Gaofeng Advisory Company. From Singapore, Louis Law, lead economist at Oxford Economics. And from Los Angeles, William Lee, chief economist and executive director at the Milken Institute. Welcome to The Point to all of you. Let's start with the basis of China's economy. For the first quarter, mind you, this is before the tariffs hit. The numbers were pretty bright, as I said. GDP grew by 5.4% year-on-year, surpassing analyst expectations. And this also marks the strongest quarterly growth in 1.5 years and builds on an already pretty high growth level of 5.3% during the first quarter of 2004. So, Edward, let me go to you first. What do you think are behind this higher than expected performance?
The first quarter's numbers are pretty impressive, as you mentioned already, but I think that this is not an abrupt phenomenon. Since the end of last year, i.e. the last quarter of last year, we already begin to see some of the uptick in the Chinese economy. So in general, as you know, last year we averaged 5.0% growth of GDP for the entire year. I think this first quarter of the economic growth was a continued outgrowth of that. There's a couple of events that happened during the first quarter. One is certainly was the coming out of DeepSeek, which is the Chinese AI model, which really surprised the world. It also injected a lot of confidence in the Chinese people about the economic prospects of China going forward. Second, of course, there was the Spring Festival, which is a period where traditionally a lot of people went out and spent money and so on. And these couple of major events in particular, because of DeepSeek, the capital market also had a surge, not for long, but certainly there was a surge. So combinations of all these events actually have contributed, in my view, to a pretty good number for the first quarter.
Louise, do you share that view? And also consumption, as I said, was pretty good, 4.6% growth. Value-added industrial output expanded by 6.5%. What specifically does that mean?
Well, I think I completely agree with Edward. I would just add that one of the things that the economy has got going for it in Q1 was also kind of the feed-through of stimulus that came into play in Q4 last year. So really going into this year, right before when the tariffs came in, the economy was actually doing quite well organically. There were drivers that pertained to stimulus that were performing well, but also if you look at retail sales, if we take out the components that were covered by the government's trading program, the other components were also doing quite well. So I would say that the economy was in a pretty sound footing at the start of the year. We talk about industrial production, we talk about retail sales, we talk about that in Q1 numbers, but actually the March number was stronger than the Q1 number. So the momentum was clearly building. And I think that's the thing that would perhaps frustrate policymakers, because the economy was finally recovering and then the trade war came in. So that kind of what the policymakers are grappling with.
Yeah, we'll talk more about that in just a moment. Let's talk about prices. William, China's consumer prices fell at a slower pace in March. The country's consumer price index, or CPI, which is the main gauge of inflation, fell by 0.1% year on year in March after a 0.7% drop in February. That's according to the National Bureau of Statistics. Does China have a deflationary problem, as some suggest?
Well, the fact that the prices continue to either stall or continue to go down reflects the fact that there really isn't that much strength in the Chinese economy. Now, granted, both Edward and Louise were talking about how strong retail sales were in the first quarter. Let me remind you that it was due to the stimulus package of bringing forward future sales into today. People were asked to trade in their appliances and their older tech products to get new tech products. So people are asked, whatever you're going to spend tomorrow, spend it today because we can give you a break on prices and we give you a break on taxes. So I think the fact that prices were not going up shows you that the strength really is there. And secondly, one of the things that the strong industrial production really shows you is a tremendous strength on the part of China's economy, which is their tech sector is very strong. DeepSeek, as Edward said, was a jolt of confidence into where China's technology can go in the future, which is very, very strong ways, despite a lot of the sanctions that have been put on electronic exports from the West. And nevertheless, all that strong production that's not being sold means prices have to go down. And if it's not sold domestically, it has to be exported. And that's where the future starts a little grim, because the largest market for China's exports is getting shut out because of the need to negotiate a new trade regime that President Trump has put in place. Going forward, it may not be so good.
Your opinion, for sure. Edward, would you like to add, or do you have different opinion on some of this? Because prices are going down, but spending has been up. So it seems like businesses are facing a slightly bruising price war, while consumers can take advantage of getting more bang for their buck. And people are buying more because of the kind of stimulus they're getting. For instance, if I trade in my old fridge and buy a new one, I can get some kind of subsidy, some kind of a discount. And a lot of people who probably wouldn't have changed their old fridge were buying new fridges because of that.
Yeah, Lucian, William certainly is right. At the same time, there's a lot of volatility, and also there's a lot of different kind of factors interacting with each other. So it's very difficult to just say it's neither entirely black or entirely white. Different factors are working together. I think on the pricing, a large part of that is also due to the property sector, which certainly have deflate for the last couple of years for the reasons that we all understand. Basically, the property sector was in a major decline. I think the property sector is now stabilizing here. Certainly here in where I am, Shanghai now, I'm already beginning to see, in a way, a little bit of upsurge. But across China, it's been stabilizing. As Louis was saying, daily consumption actually was quite vibrant. So, these sort of things are counteracting with one another. Even the trade war issue, in my view, it certainly gives a lot of uncertainty. At the same time, the Chinese government, by putting into a lot of this kind of measure, is trying to drum up the domestic consumption, which also is interacting factor to the external challenges.
Yeah.
So, in general, I see the rest of the year is going to have some bumps. There's some periods of ups and there's some periods of down, and maybe some periods of stagnation.
Right.
But in general, I think the rest of the year should be pretty good actually for China.
Well, if you look at the consumer sentiments, one thing we noticed, and that's been reported, is that during the May Day holiday, which just ended, there were 1.4 billion trips, literally every single Chinese, if you count, the babies and the elderly, 1.4 billion trips were made during the May Day holiday. If people are so pessimistic about the economy, probably this wouldn't happen. Louise, how do you look at that?
Yeah, I think the kind of alternative data, like the number of trips, the movie ticket revenues, things like that, those are pointing to pretty encouraging signs. But we've seen that in 2023 as well. If you recall, we did have a strong start to the year, and then it fizzled out quite quickly. So I think the key here is really, whether or not policymakers can sustain a supportive environment for these type of spending. I think investors, market participants, we have been disappointed before by talks of stimulus and then not really following through on implementation. So I think here is really where the market participants as well as the domestic consumers onshore will be looking to the government to see if they can continue a somewhat supportive stance. I think that's probably key.
Three key institutions actually jointly announced the measures, namely the Central Bank of China, the National Securities Regulator, and the National Financial Regulator. William, despite your take on the health of the Chinese economy, what does this lineup tell you about the at least the intended effect of these measures?
I think if you line up not only the central bank and the securities regulators, but add them up to the fiscal stimulus that was put in place in the fall and further packages that are probably yet to come in the future, it shows that the Chinese authorities are very determined to get GDP to stay at that target of near 5% growth. And regardless of how the composition turns out, if exports fall off, I think the authorities, by lowering the cost of credit, borrowing money, they want people to be able to spend money domestically to make up for whatever shortfalls will come from exports. So that's very clear. The intent is to keep the economy going, keep jobs growth growing, and keep salaries going. And those are key to the future of China. And I think every policy measure is being pulled out to try to do that. And I'm guessing even bigger policy measures will come after any kind of negotiations are underway with the U.S. in terms of reforming the tariff and trade situation. So I think the intent is all there. The issue is every policy measure that has tried to stimulate the economy in the past has had less than the effect that it was intended. So people have said, all right, I thank you for these measures, but I don't believe that that's enough. And I think the message, that very clear message from the markets, the poor reception of the markets this time compared to September, they're telling the policymakers, you got to do more. And you got to do more on the demand side. President Xi has shown himself to be very successful in stimulating new technologies, the new electric vehicles, the energy, and the high value added production that China needs in the long term in the future. But in the short run, he's got to make people confident that my income is secure. My property market values, even though they've fallen a lot, will not continue to fall any further. My wealth is preserved. And one way of doing that is, in some ways, to put in place a social safety net. To tell retirees, your future is secure regardless of what happens to your job right now.
Yeah, well, we do see the numbers, right? We do see the hectic travel season during the May Day. We do see the upticking of consumption and the GDP as a result of previous rounds of policy support. So it's really a very mixed picture, aren't we? I mean, some people are always going to be unhappy or unsatisfied with the policies that are rolled out. Nevertheless, I feel that this is not deterring the Chinese central government to continue rolling out policies to maneuver, the tools in their toolbox. Now, one of the things this time that was one of the major announcements was China's central bank lowering the borrowing cost of its 7-day reserve repurchase agreements, or what is known as policy rate, by 10 basis point or 0.1% to 1.4%. Edward, talk to us about the significance of that. Exactly how is that intended to shore up confidence, to provide long-term liquidity and boost the economy?
Yeah, I think this policy is to provide more liquidity in the market by making money more available to enterprises as well as to individuals, but mostly actually to enterprises, in my view, especially towards the kind of enterprises which has been suffering over the last couple of years, either because of COVID or because of the relationship with the US in the last couple of years. And most of them are actually SMEs. And these are, enterprises actually need more funding, more financial support to regenerate their commercial activities. So, by definition, more liquidity means more commercial activities. And, this is what I believe what the business communities are looking for actually right now.
Louise, how do you look at the policy rate drop? I mean, this follows a 20-point drop in September 2024. Why a further drop now? And what kind of impact is this going to have on the ground?
Well, I think we probably have to bear in mind that the PBOC, the Governor Khan himself, has actually signaled that a rate move was coming as early as the end of last year. So this was always going to come. The renminbi's depreciation pressures are also decreasing, so there is a bit of window for them to cut rates. When we look at the quantum of rate cuts, 10 basis point, yes, it does introduce some liquidity into the system. But I think that the broader macro impact of that, because it's just 10 bips, it's not going to matter that much. But I think the signal of that measure, the mechanical action of rate cuts, is gonna have a confidence effect on the rest of the economy, and that we think is the start of a rather protracted monetary easing cycle. And that's precisely why the central bank needs to cut rates, because the real rates, or the real financing cost, which is, we like to simply just the nominal rate minus the inflation, your real financing cost is actually quite high for households and for corporates. So if you cut rates, you're actually ensuring that easier credit goes to the hands of these businesses that need it most. So I think it's a welcome move. But our general sense is that it's a necessary but not quite a sufficient move to really turn the economy around from the drags of tariffs.
That seems to be the opinion of quite some economists on these moves, positive yet modest. I'm going to throw this question to William and Edward. You seem to come from slightly different opinion. Maybe William first, but then Edward. Why is the Chinese government very careful about moving these policy rates? They're very, very prudent in doing that.
These are very small rates, 10 to 20 basis points. When the United States moves the policy rate, it's at minimum 25 basis points, and sometimes as much as 50 basis points. So the order of magnitude is very different. Now, China is much more dependent on banks and borrowing. So a little bit goes a long way in many ways in China. So that's one way of explaining these very small prudent measures. But one thing to remember is that monetary policy takes a long time to work. It takes about a year to year and a half before it really feeds through to the economy. But meanwhile, the short-term drop in confidence and consumption that the government was worried about all of last year, that has to be addressed very quickly. And that's why those stimulus measures were put in place to get people to consume more. So it's a package of both, right? In the longer run, monetary policy will try to lower the cost of borrowing, but in many ways, economists call that pushing on a string. Unless people are willing to borrow, even though you charge them nothing, you're still not going to borrow unless they know they're going to make money from investing in new stuff. And they won't believe you they'll invest in money, get money by investing in new stuff, unless you see demand start to pick up. And that's where fiscal stimulus package is so much more important right now. But monetary policy is very important in the medium to longer term.
Edward, what is your take? Do you think these policies are too modest, or China is very careful about not to flood the market with too much hot money?
Yeah, certainly one can say the Chinese authority are a little bit conservative in this kind of approach. But also back to the point that William was making, I think there's a different point of views on the effectiveness of fiscal policy versus monetary policies. And so far, Lucian, as we've seen so far, as you discussed, what we see mostly or entirely from China is the monetary policies, whether it's prudent or not prudent, is basically monetary policy. I think the difference between the two, i.e. monetary policy and fiscal policy, is that with monetary policy, you need to exercise some kind of commercial activities or some activities to generate the productivity that you need. That's the purpose of monetary policy. So productivity be generated in the community. Whereas fiscal policy, as William said, has the benefit of being very fast, because once you get some money, you would spend it, or you can keep it, or whatever, right? That's very direct. But it doesn't really generate that so-called productivity in the process. So there's trade-off between the two. It's not one is better or the other is better. But I think the Chinese government, as we've seen so far, they rely on monetary policy. I believe that they like to use that as a way to generate commercial activities. Whether or not that's sufficient, of course, it depends on one's point of view. In my view, the Chinese government always has something in the pocket, which is now being manifested more and more, is how to migrate steadily, actually quite fast now, into technology innovation and use that as a mechanism to generate additional productivity.
Right.
And that's a major tool that the Chinese government have in its hands, and we can talk more later about this.
Yeah. Well, let's try to cover some more ground. I mean, there's actually a 10-point package of support. But if you look at the effectiveness, I would say some policy have been extremely effective. If you look at, for instance, the rate of white goods, people purchase a new white goods to replace their old one, that actually jumped by 150%, as the latest announcement. I think that shows that the Chinese government knows how the Chinese consumer think and how they behave, so they have the right way to, boost that kind of demand. But let's talk about some of the other measures that are being rolled out. For instance, a temporary reserve ratio requirement exemption for auto finance and financial leasing firms from 5% down to 0%. Louise, why have authorities chosen these sectors in particular for additional boost? And the margin seems to be quite big, from 5% to 0%.
Yeah, so I think this is both a supply side and a demand side support, right? On the supply side, it really tackles the problem where these sectors, traditionally seem to be operating above capacity, right? So there is a level of oversupply in these sectors. So you're kind of pushing them out. And on the demand side, you're encouraging kind of the spending or consumer purchases around some of these big ticketed items as well as services. So I think it kind of works both ways. You can see the rationale behind that. But again, I think it's also critical to note that these type of measures comes as a package, right? So we don't look at it in isolation, but we look at it as policymakers are not just targeting different baskets of spending, but they're also targeting some of the upstream problems of consumption. So like, job stability, wage growth, issues like that would really have a more sustaining, staying power on encouraging confidence.
William, your take on the specific sectors that are being supported, and this time we're talking about financial support to be given to tech innovation, service consumption and elderly care. Why financial support and why these sectors?
Well, the elderly care was very clear because that's part of that social welfare package that I was talking about earlier to help people assure that they have a secure retirement. But the other sectors, the electric vehicles and the high-tech sectors, that is to really encourage more spending to buy more of that production. Now, Edward said that monetary policy was driven toward increasing productivity in the Chinese economy. Right now, the productivity is so high, China's produced so much stuff that it's just sitting around not being sold. So I think a lot of the packages are put in place so that a lot of the inventory, the excess inventory that's gathering dust, is actually being sold. And I think that is one way of encouraging companies to build more of these highly productive products. So it's a cycle that has to be kept rolling, or else once things stall out, that would be a huge setback to where China wants to go, which is to be a big producer in the high value-added industries, which is the objective of what President Xi has been trying to do for the last 10 years in the Made in China 2025 program, and it's been very successful. But in order to keep that, the other way of selling this stuff, of course, is by selling abroad. And the reason why you need the stimulus package now domestically is because the prospects of selling abroad all this stuff, the electric vehicles and solar panels and such, are diminishing by the day as trade starts to shut down.
Is there going to be a short-term bump or a longer slope, Edward? Because tariff, for now there is a shock, right? A lot of shock, and the world is confused and even angry. But is Chinese products going to lose ground in the international market? I mean, or are they just going to face some temporary bumpiness on the road?
Yeah, everywhere I go in China now, when I talk to my clients, these are senior people in the corporate world, there are only two things in the mind, or maybe two and a half things. The first thing is AI or technology innovation. Second is tariffs, which I'll talk a little bit. And they maybe the one half thing is going overseas, or, investing or taking part in international activities. Certainly, the tariffs is a big issue on the mind of the Chinese businessman. I think we can see that right now there's a lot of uncertainty and instability in the U.S. Policies. One day Donald Trump will say this, the other day he will say some other things. At the same time, I think we're beginning to see a major shift in the world, because probably largely because of Donald Trump's decisions on so-called tariffs. The world is changing. It's shifting, actually. The trade flows are shifting. Relationship between nations, including in particular China, is shifting. We see, as you know, recently the collaboration between China and the Asian countries, and also Japan and Korea. That bloc is being formed, and we also seen some fundamental changes in the relationship between Europe and China in terms of their economic relationship. And I think we're beginning to see this kind of major shift. So is China entirely relying on the US? Yeah, US is important, but is it very important? No, it's not that important. US is the third largest trading partner with the, US is only the third largest trading partner from the standpoint of China, behind ASEAN and European Union. And, trade with the US only account for less than 3% or only 2.5% around of China's GDP. So yeah, it has some impact, but it's not a significant impact.
Well, let's not forget, the Chinese market is also a huge market with a growing middle class. And immediately, the Chinese domestic market and also other international markets than the United States start to be the new ground for cooperation, for transaction for Chinese companies, which were originally exporting to the United States. Louise, is the world big enough for Chinese products? And of course, is China a big enough consumption market for products from around the world?
Well, I think from the Chinese economy standpoint, that growing middle class that you talk about, the problem with this growing middle class is not the ability to spend, it's the willingness to spend. So unleashing that would actually have pretty significant synergistic effects on the rest of the economy. So that's the policymakers' challenge. When it comes to Chinese goods in kind of the global stage, we know that Chinese products, at least Chinese manufacturers, have had not just a good say in the final products, but also in the intermediate products that go into producing the final products. So China is actually very much embedded into the global supply chain. So if you think about US and China, for instance, bilateral trade flows, our analysis suggests that the US is going to have a harder time finding alternative suppliers than China is going to have, than the time that China is going to have finding alternative buyers. So really, the trade war, you can see China being in a bilateral trade surplus position, and a lot of people talk about that being a losing hand. But I think the truth is probably quite conversely true, because in this case, Chinese products are price and product competitive in the global stage, and therefore I think a trade war with the US at such punitive levels is just going to cause a lot more redirection of trade flows to other markets.
We have to leave it there. Thank you so much for my guests, Edward Sear, William Lee, and Louise Liu, for sharing with us your valuable insights. On behalf of the whole team, thank you for watching. As always, you can follow me on Facebook and X using the handle Lucian in Beijing. That's it for this edition of The Point. You've got the point.